Welcome to the HouseLux Estate channel, your #1 stop for all things related to finance and estate management. We're here to help you navigate the intricate world of finance, one topic at a time. Today, we dive into a riveting subject that is often overlooked but holds immense value: the significance of dividend policy in corporate finance. Now, you might be wondering, what's so special about dividend policy? Well, it's not just about companies deciding to distribute profits to shareholders. It's a strategic decision that can greatly influence a firm's financial structure and market perception. It's the fine line between retaining profits for reinvestment and rewarding shareholders. With the right understanding of dividend policies, you can make informed decisions, whether you're a finance student, a corporate executive, or an investor. So let's embark on this journey together and unravel the mysteries of dividend policy. Stay tuned to learn more about the importance of dividend policy in corporate finance. First and foremost, what do we mean when we talk about dividend policy? At its core, a dividend policy is the set of guidelines a company uses to decide how much of its earnings it will pay out to shareholders. These dividends can be viewed as a reward to the shareholders for their investment in the company. Now, this may sound straightforward, but there are actually several different types of dividend policies that a company can adopt. Let's delve into a few of these. Firstly, there's the residual dividend policy. Under this policy, a company pays dividends from the residual or leftover equity only after all project capital requirements are met. This means that dividends can vary from year to year, depending on the company's earnings and investment opportunities. Secondly, we have the stable dividend policy. As the name suggests, this policy focuses on stability. Companies following this policy try to maintain a consistent dividend payout, regardless of their yearly earnings. This policy is often adopted by companies that have a stable income and a less aggressive growth plan. Thirdly, there's the hybrid dividend policy. This policy is a combination of the residual and stable policies. Companies adopt this policy to maintain a stable dividend payout and also retain a portion of the earnings for growth opportunities. Lastly, we have the zero-dividend policy. Some companies may choose not to pay dividends at all, especially if they are in a high-growth phase. They prefer to reinvest all earnings back into the business to fuel further growth. Each of these policies has its own merits and demerits, and the choice largely depends on the company's financial situation, future prospects, and the management's approach towards shareholders. So why is all this important? Well, the dividend policy a company chooses can have significant implications for its financial health and the wealth of its shareholders. Understanding the concept of dividend policy sets the foundation for our discussion on its significance in corporate finance. Now that we understand what dividend policy is, let's delve into its role in corporate finance. Dividend policy is like the steering wheel of a company's financial vehicle. It's how a company decides to distribute its earnings among shareholders and what portion to keep for reinvestment. This policy is a critical aspect of a company's financial management strategy and plays a pivotal role in determining its growth trajectory and financial stability. Imagine the earnings of a company as a pie. The company can choose to distribute the entire pie, a slice of it, or none at all to its shareholders as dividends. The rest, it can reinvest to stimulate growth. This choice, in essence, is the dividend policy. A company with a high dividend policy will distribute a larger portion of its earnings, providing immediate returns to its shareholders. This can be attractive to investors seeking a regular income. However, this leaves less for reinvestment, potentially slowing the company's growth. On the other hand, a company with a low dividend policy retains more earnings for reinvestment. This can accelerate the company's growth and potentially increase its market value. But this approach might not appeal to investors seeking immediate returns. Therefore, the dividend policy is a balancing act. It reflects a company's long-term strategic goals. Whether a company wants to attract income-focused investors with high dividends or growth-oriented investors with the promise of increased future earnings, the dividend policy is a key decision-making tool. Moreover, the policy also signals the company's financial health to the market. A consistent dividend policy can be interpreted as a sign of the company's financial stability and future prospects. In a nutshell, the dividend policy is a significant tool in corporate finance. It not only determines the financial path a company will tread, but also influences the kind of investors it attracts and retains. The dividend policy a company adopts has a direct impact on its financial growth and the satisfaction of its shareholders. Dividend policy does not exist in a vacuum. Several factors influence it. Let's delve into these factors, starting with the company's profitability. It's simple logic, right? The more profits a company makes, the more it can distribute as dividends. So the level of earnings is a key determinant of a company's ability to pay dividends. If a company is in the red or barely making profits, it's unlikely to distribute dividends. Next up is the cash flow situation. Even if a company is profitable on paper, it needs actual cash to pay out dividends. If a company's cash flow is tight, even with high profits, it might hold back on dividends to ensure it can meet its operational costs and financial obligations. Investment opportunities also play a significant role. If a company has a lucrative investment opportunity that could yield higher returns in the future, it might choose to reinvest its profits rather than distribute them as dividends. This is often the case with growth-oriented companies that prioritize expansion and future earnings potential over immediate dividend payouts. Legal restrictions are another crucial aspect. Companies are bound by certain laws and regulations when it comes to dividend distribution. For instance, some jurisdictions restrict companies from paying dividends if their retained earnings are negative. So, legal and regulatory frameworks can directly impact a company's dividend policy. Lastly, let's not forget about debt levels. High levels of debt can limit a company's ability to pay dividends. After all, lenders and creditors are paid before shareholders, and high interest payments can eat into the profits that might have been distributed as dividends. In a nutshell, a company's dividend policy is shaped by a complex interplay of factors including profitability, cash flow, investment opportunities, legal restrictions, and debt levels. It's a delicate balancing act, requiring strategic decision-making to balance the interests of shareholders with the long-term growth and survival of the company. These factors play a crucial role in shaping a company's dividend policy. To better understand the significance of dividend policy, let's look at a real-world example. Consider the case of the multinational tech giant Apple Inc. Apple, known for its innovative products, had a long-standing policy of not paying dividends. For decades, the company reinvested all its profits back into the business. The goal was to fuel growth, spur innovation, and maintain a competitive edge. This policy was in line with the tech industry's general preference for growth over dividends. However, in 2012, Apple made a landmark decision to start paying dividends. The shift was a result of mounting pressure from shareholders who wanted to enjoy a share of the company's massive profits. Apple's decision to initiate a dividend policy signaled a new phase in its financial strategy. This change in policy had significant implications. Firstly, it demonstrated the company's confidence in its stable and robust cash flows. It also indicated Apple's willingness to share its success with its investors. Furthermore, the dividends made Apple's stocks more attractive to a broader range of investors, including income-focused ones. On the downside, some critics argued that the decision could limit Apple's flexibility in capital investment and potential for future growth. However, Apple's sustained growth and innovation in the years following the initiation of its dividend policy have largely silenced these critics. Interestingly, Apple's case is not isolated. Other tech giants like Microsoft have also embraced dividend policies, balancing the dual objectives of growth and income distribution. As shown in this case study, the dividend policy can have far-reaching implications on a company's financial health. It's a delicate balance that requires careful consideration of various factors, including the company's growth prospects, financial stability, and shareholder expectations. It's no wonder that dividend policy remains a hot topic in corporate finance today. We've come a long way in understanding the significance of dividend policy in corporate finance. We've seen how it acts as a crucial tool in the financial management of a corporation, affecting not only the firm's liquidity, but also its investment opportunities and market reputation. We've explored the various factors that influence a company's dividend policy, such as business cycle, profitability, legal constraints, and the company's growth prospects. Through a case study, we've seen how the right dividend policy can have a positive impact on a company's financial health and investor confidence. In essence, a well-structured dividend policy is a delicate balance between retaining earnings for future growth and distributing earnings to shareholders. It's a strategic decision that can significantly influence a company's trajectory. Thanks for tuning in to House Lux Estate. Remember to subscribe for more insightful content on finance and estate management. Until next time, keep investing wisely.